Hello and welcome to this special show. The Mutual Fund Report Card is what we call this. Every quarter we get together with the industry to understand what did CRISIL's Mutual Fund ranking throw up for the quarter, but more importantly, what are the trends going ahead as far as the industry is concerned. Joining me today on the show, S. Narain, CIO Equities at ICICI Pru AMC, Lakshmi Iyer, Head of Fixed Income and Products at Kotak AMC, and Jiju Vidyadharan, Head Funds and Fixed Income Research at CRISIL. Thanks very much, all of you, for coming by. Jiju, let me first start with you. What interesting has this quarter really thrown up? We have been going through a fairly tough period as far as funds are concerned. What was the most one or two significant things that came up this quarter?
Okay. This quarter, if you were to just look at the performance bit, large cap funds have done relatively better than the rest over the latest 3 months. Over a 6-month period, it's actually small and mid cap which has done better. Again, over the last quarter, what is also interesting is that the benchmarks seem to have done better than the funds. But over a longer period, if you were to look at a longer period beyond 1 year, funds have been doing fairly better than the benchmarks. So that's really the performance.
For a year now, they've been outperforming benchmarks.
Right, right. And further as well. So, 2, 3, 5 years and so on. The other interesting fact really on the debt side is that gilt funds have over the latest quarter really done the best. So that can also to a very large extent really be attributed to the rate cut by the RBI. So gilt funds have really done well. In terms of assets under management, equity continues to be a little grey in terms of inflows, and on the debt side, there is a shift really that can be seen on the shorter end, where money seems to be flowing out of ultra short to liquid funds.
So Lakshmi, let's try and get a sense of what's really been happening as far as debt funds are concerned. Gilt funds, according to this report, were the best performing among all other categories. Right. Could you explain to our viewers why that has happened?
See, a couple of things. One is there is a general expectation that the economy domestically is slowing down, and that obviously is fueling a lot of expectations of rate cuts on the benchmark front. We've already seen rate cuts in April, started off with the CRR cut, which lent a lot of liquidity boost to the system, and subsequently we cut the repo rates. And going forward, the expectation is that if you have to pump prime the economy, rate cuts are essential. So on the back of that, we've seen a reasonable good rally in the gilt segment. And of course, RBI, in a way to ensure the liquidity in the system, has also been supporting the market with open market operations. And open market operations leads to an additional demand, which is from the central banker. So a combination of all these factors is what we've seen the spectacular rally in gilts.
So are you saying that going forward, if the RBI were to cut rates, and I'll get your thoughts on that, what your own opinion is, but if that were to happen, are you saying that the performance could be even better?
That's right. That's exactly what we believe. If you're talking about at least a 50 basis rate cut going into the end of this financial year on a base case scenario, even that we believe is a reasonable good stimulus for the rally to get extended through the remainder of this year, is what we feel.
Lakshmi, liquid funds or gilt funds often get compared to saving bank rates.
Sure.
If 3.1% over the quarter was the rate of return, how would you fight for that money as far as an investor is concerned?
See, it's a different category altogether. When you're talking about investments in gilt fund, you're talking about taking interest rate exposure, which inherently is volatile. So which is why, whereas a savings account is a complete, I would say, a safe haven where since it's in a bank deposit or, it's with the bank, there is an assurance or a predefined rate of interest. That is not true when you're investing in a gilt fund or even for that matter in a liquid fund. So what you can at best guess or try to conjecture is what kind of yields or returns are likely to accrue to you at the end of your investment horizon based on your interest rate expectations. So
and if you were to lengthen that period to say let's go away from a quarter and let's go to a 12-month period, do you think that liquid funds have given better returns post-tax than saving bank accounts?
That's right.
They have.
They have. On a post-tax basis, liquid funds have outperformed, at least till the reasonable past, they have outperformed savings plans.
Okay. Let's move to equity, Naren. Is the mood any better? Are you smiling more these days?
No, obviously there's a global risk on happening now.
Okay.
1 month you have global risk on, next month you have global risk off. We've been used to this now for some time.
You believe right now we're in risk on?
Yeah, obviously we are in risk on. Actually, I think European markets are at 8-week high or 4-month high. And we've seen continuous rallies in some of the European markets. So we've seen a good global risk on phase. What we in the equity market are waiting is for a local risk on phase. And that local risk on phase requires...
Explain that to me.
What I mean is that, see, today if you see the stocks which are at, like, you know, even though the market is not at all-time high, there's a set of stocks which are all at all-time high. If you see a select set of FMCG stocks, a select set of pharmaceutical stocks, a select set of very defensive high-quality names, these are all trading where the market was at 21,000. They're trading even higher than that, actually. So I think what's happened locally is locally you actually have a risk-off phase for a long period of time where people are hiding in high-quality stocks paying very high valuations. And there's a fair amount of stocks which are actually cheap at this point of time where people are not willing to invest because of the risk-off locally. So my reading is that we were all expecting that we would have a diesel price hike followed by a rate cut, which actually would have led to a local risk on trade. There's a global risk on trade which will happen and go off also periodically, but you could have a local risk on trade. That we're still waiting. We've been waiting for the past 6 months. We're still waiting.
How challenging have the last 3 months been for you from a fund manager's point of view? Therefore, on the one hand, you have an expectation of delivering returns, and as we were just discussing, it's actually been the gilt funds which have been better performers than even equity funds. So on the one hand, of course, you have that pressure to tell your investors that, look, you know, things will get better. On the other hand, of course, that's the reality of the market. How difficult has it been? What has your strategy been in this?
See, the challenge is that, you know, when you buy high valuation stocks because they are high quality, it's actually very comfortable because you're buying high quality names. So we are doing that and making money. But, you know, we would love to have a situation where we take a little bit more of risk, buy a cheap stock, and that cheap stock delivers. What strategy which has worked for us is actually picking the high quality names and investing in them, not the other situation. This has happened now for almost 3 years now. So we would love to move to that other phase. But it isn't very challenging in the sense that because markets are not in a phase like 2007 where you don't understand what is happening to the market. I think it's pretty obvious what's going on in Europe. It's pretty obvious that you have an oil subsidy problem. It's pretty obvious that in this current quarter we've seen problems on monsoon. So I think these things are all there for us to see, so it's not so complex. But at the same time, you know, would love to make money for investors in equity. And we would love investors to invest in equity feeling that they'll make money in equity.
And right now they're not.
Right now they're not investing in equity, and you know, that kind of irritates us.
You've made the point in the report about AUMs, and we've all seen that the industry has been seeing more of net outflows than inflows at all. Could you share some of the data that you put together for that quarter in terms of where the industry stands in terms of inflows, outflows, AUMs, etc.?
Yeah, so, you know, if we were to just look at it, you know, between equity and debt, equity has largely been static. You know, this, if at all there is outflows really in terms of net figures, that has really been happening on the equity side. In case of debt, you know, the short end really liquid and ultra short, there is some action really happening with a lot of money flowing into liquid funds. FMPs again have been quite popular. Ultra short funds have seen some disinterest. You know, there's been money that has been flowing out. What is also interesting is gilt. You know, despite really being the best performer for the quarter, has really seen an outflow. The size of gilt funds as a proportion of the total industry AUM is...
Why do you think that is up?
That could, you know, to a very large extent really be attributed to lack of clarity in the minds of the investors really in terms of what would be the policy action, in terms of interest rate cuts and so on. So, while there has been a lot of talk really about rate cuts, it has taken its time really. So that lack of clarity could really be one factor. The other interesting point really about the gilt fund AUM per se is that it is significantly concentrated amongst corporate investors. So close to 70% is really what comes in by way of corporate investments. So that also highlights the fact that probably retail investors are really missing out on a category which, especially in the present interest rate environment, can really offer good returns.
You talked earlier about large caps having done well. Why?
So large caps...
and how would you distinguish, is the gap significant between those like one of Narain's scheme which continues to hold on to the #1 ranking? Is there a big difference between say 1 and 3, or is that a very narrow gap?
Between funds there would be a decent bit of difference, but within categories we would really be looking at category averages. Right. So the large cap funds as a category compared to the mid cap category on a quarter-on-quarter basis there isn't really a significant difference.
And you're saying they've done better than the rest of the categories?
Right.
Why would that be the case?
That would largely be on account of the current market environment really. So large cap stocks as a whole would really have done well, and that could be one factor which would have really driven up the performance for that category.
Would you want to add to that, Naren?
No, actually,
has the defensive stand of being
actually
with
in the
blue
last
chips
3
worked
months
better?
Yeah, that's true. But actually, if you see today in our own portfolio of products, the longer-term returns on mid-cap funds have dramatically improved. Okay. I mean, if you not the last 3-month basis, but if you see 1 year, 3 year, there are like mid-cap oriented funds which seem to have done pretty well. And the reason is in mid-caps you are able to do bottom-up investing. So you're not so sector focused. Whereas if you see the large caps, there are some components of the sectors which have just done pretty badly over the last 1 year or 3 years. So I would say, yeah, right now if you ask me, on the basis of past performance, mid-caps actually seem to be good, except beyond this 3-month phase. This 3-month was a phase, the previous 3 months mid-caps had done extremely well. So, it has gone through a phase of consolidation relative to the large caps. But we're not so large cap or mid-cap. I don't think the difference has been so substantial at this point.
Okay. Lakshmi, let's move beyond the more shorter-term gilt or liquid funds and go slightly more longer. How has the performance been there? What have the challenges been there?
See, on the longer end, if you see most of this rally, if you talk about calendar year to date, bulk of the rally has been at the longer end of the yield curve. It is now in the recent last, say I would say 3 or 4 weeks, you've seen renewed buying interest at the shorter end of the yield curve. And somewhere some sort of a catch-up game is happening from that perspective. So our sense has been that your longer end of the yield curve has significantly outperformed the shorter end of the yield curve. And now going forward, you would see some sort of a lull happening at that end because the catch-up game eventually happens. You can't have a scenario where the yield curve is inverted for a very long time, and therefore we're seeing a little bit of money flow happening towards the shorter end with a reasonable participation happening at the longer end of the yield curve as well.
What would be the key challenges that you would be facing? For example, we do know that there is a lot of stress among a lot of corporates,
right,
and therefore probably fundraising or CAPEX plans being put on hold.
Right.
Could that be an issue going forward? Is that something that concerns you?
See, there are a couple of things which, as a fund manager, which concerns me right now is that one, we are not in a trending market as far as interest rates are concerned. So obviously trying to catch the pulse of the market, in a way I would say it's a volatile market. So you've seen yields back up calendar year to date itself, go as high as 875, come down to a low of 8%, and you have to capture those volatilities to your client's advantage. That is on the interest rate front. On the credit front, obviously with the economy not doing so well, it's natural to have higher potentials of a downgrade or probably a default kind of a scenario, and to that extent being able to identify the right kind of credit and make the right kind of investment is a dual challenge. So you have a dual I would say a Interest rate factor, obviously we all know rates are likely to come off from what we are, but it's not going to be a straight journey downward. So it's a dual challenge right now which you need to harmonize to your best possible abilities to be able to generate that incremental alpha to your client.
If an investor were to get in with a year or 2-year kind of a time frame, do you think that would be sensible? Because I know it's difficult to predict, and in fact we started the year everybody expecting that we are going to have very strong rate cuts, and we've pretty much reached August and we've only seen one set of it.
Absolutely.
But let's go further and say if you had a 1-year kind of a time frame, would it make sense to enter a debt fund right now according to you?
See, I think the pace of interest rate cuts are clearly going to be gradual. So as you rightly said, the gung-ho expectations have been simmered to a very large extent by the governor himself, and obviously rightly so because of the inflation concerns. We believe the more gradual the interest rate downward movement is, contrary to what it was actually in 2008, 2009, there is that much higher potential for an investor to participate in the rally and probably be able to live through the entire cycle with a 4 to 6 quarters, which is a 1.5 year kind of a horizon.
That's a horizon you think should be there in the mind, unless you're willing to take the risk of interest rates and try and catch a falling knife, so to speak.
That's right. We're okay with clients coming for shorter horizon.
But they should be clear in their mind
Absolutely.
that we're coming, this is not something which is going to give me a stable return. It's going to be volatile, but if I want a year and a half kind of a window, then I might want to go to a good long
duration fund. Absolutely.
Bond fund kind of.
That's right.
Naren, what are the sectors you've been buying? I know we can't talk stocks here, and I'm sure that your strategy would be about picking good stocks within a sector. But just to get a sense, you did talk earlier about certain sectors not having done well. If you were to identify 2 or 3 sectors which have really done well, or you are bullish on, and 2 or 3 which you're bearish on.
See, I think what we've been trying to do is look at the fact that if you're able to get good exporters cheap, buy it. It's a strategy which has only partially worked. We've also looked at investing in many import substitution companies. Because see, we are in the phase today, you know, the best performers of the last 3 to 5 years have been FMCG and the pharmaceutical field. Those stocks are not cheap. So we've been underweight now FMCG for a while. But the stocks have continued to outperform, but you don't see that upside which you want to see. So we've been actually nibbling into, if you see the high quality import substitution companies, we've been nibbling into even telecom at this point of time, because our belief is that if you take a 3-year view from here, these are the sectors which are going to give you very good returns. And we've been avoiding the low quality companies which are highly leveraged in the infra space for a while. That's worked for us. I think till the interest rate cycle turns, I think we're still going to see that underperformance continue. That's a sector we've been underweight for a while. We've been slightly underweight the financial space because of this worry on inflation and current account deficit and fiscal deficit. That's also kind of worked, but you know, going forward, if you see the current year, actually financials have done well. So I think with a 3-year view, it's very clear, invest in the dogs. With a 1-year view, actually, I would still say quality may still work. That's what we think.
But with a 1-year kind of a time frame, or even a 1.5 year kind of a time frame, are you bullish on this market?
No, we believe right now it's much better to invest with a 2 to 3 year view right now. I mean, it's a tough task which I find when I meet distributors as to how to convince them, because now 5-year returns have been close to 0, and I'm telling them now to invest with a 2-year view. But the fact is that, you know, you've had a bad monsoon. If you ignore the global risk on trades which happen, you're going to suffer from the impact of a bad monsoon. Yes, so unless the monsoon improves or crude oil again falls like what it did in June, which caused a rally in the market in June, we are in a phase where the 1-year return is not clear. Whereas the 3-year return is pretty clear, because you would have had 8 years of very low returns, and you're surely going to see a situation where the earnings have substantially increased from 2007 to 2014-15. Then the return potential on a 3-year basis looks very good, but on an annual basis it's not clear.
Jiju, what's the sense have you got when you've looked at you know, the statements of all the mutual fund companies? Are they more convinced about deploying cash, or are they sitting on more cash? Is there some kind of an indication that you've got?
At least at this point of time, if you were to really compare it with 6 months back, the extent of cash holdings has reduced across funds. So they seem to be inclined to invest more at this point of time.
Mm-hmm. And if you were to, do you at all through these rankings also look at thematic sectoral funds? Could you tell us a bit about that?
Yeah, so we actually look at infrastructure as a category.
Okay.
Infrastructure funds, funds which predominantly invest into the infrastructure sector. Now, this category, has really done, it would be amongst the worst performing categories really within equities. Mm-hmm. And that has really been the case for some period of time now. Even if you were to look at the performance of this category across different time frames sitting today, even at if you were to look at a 5-year time frame as well, the category has really given significantly negative returns. So that's one category which we really look at from a thematic perspective.
Lakshmi, have you at all seen some retail interest in debt funds?
Phenomenal retail interest.
Really?
Absolutely. In the last 7 months, as Jiju said, it's not been significantly into the gilt segment, but in the long duration bond funds, which also participate in the gilt side of the segment, the response has been phenomenal. So we've seen, in fact, whatever AUM growth we've seen in the last 6 to 8 months, I would say 90% plus has actually come in from the retail segment.
Mm-hmm. And that would explain what? Flight to safety?
Yeah, because if you have...
I hate to pit you both against
but
each other.
But the fact is that equity inflows have been very muted. Actually, they've been negative.
But are people continuing with their SIPs, Naren?
They are continuing with SIPs. We are seeing some old cancellations and new SIPs. So I think, what happens is as interest rates go up, you see home loan installments, let's say, go up. That leads to a situation where some of the people are forced to cut their old SIPs. You have new people joining up on SIPs. At the same time, I would say while the outflows happen when the markets go up, now it's almost 5-6 years when they have not invested in equities. That's rather worrying at this point of time, because today when we speak to the insurance people also, even their product range has become much more fixed income oriented rather than equities. What it means is in the last 5 years, if I take asset allocation as a model, investors are continuously cutting their allocation to equities.
And that's not necessarily very prudent.
Yeah.
Right. Okay, we'll leave it there. Thank you very much, all of you, for coming by and sharing your thoughts with us. Well, that's all the time we have for you. We'll, of course, be back next quarter again with a fresh report card. Thank you very much.